Good morning, everyone, and it's a great pleasure to be here. My name is Mike Wilkins. I'm the Head of Infrastructure Finance Research at Standard & Poor's Ratings. Let me just get my presentation up. I'm going to be talking to you and give you an introduction to the latest developments in the infrastructure and project debt markets. I'm going to focus mainly on the theme of our latest research S&P ratings, which is on the paradox between the deficit that we see in funding for infrastructure versus the financing surplus which exists in the private sector, which is a key problem in terms of releasing the deal flow into the market. And I'll come back to that later on, but that's going to be a major theme of my talk this morning. But before I get into that in any detail, I wanted to just give you a quick overview of what's been going on over the past year in the world of infrastructure and project debt. I think the first thing to highlight, and one which we specifically pointed to at the beginning of this year in our research, is that the project lending is not dead. Rumors of the death of project finance lending have been grossly exaggerated. In fact, project lending is very healthy. In fact, it's gone back up to pre-crisis levels, and the banks have no lack of appetite to lend into the project finance market. The question is why? And we go into that in our research, which you can get outside at the break. But principally, it's because project finance lending is a profitable business for them. At this current state of low rates and cheap funding and liquidity for the banks, it is logical and it makes good sense for them to be in the market, especially as they can pick up on premium margins, especially on the refinancing side. When we talk to bankers, they expressly say that in the current market where there's opportunities to amend and extend and pick up extra fees in that way, and also because the state of the market has now has got through the sort of the pain of Basel III. Most banks have repaired their balance sheets and have got funds to put into profitable lines of business, especially in project finance, where you can actually benefit from auxiliary business lines such as providing either advice or derivatives or swaps, as well as the mainstream lending. So to cut a long story short, project finance lending is an attractive business line for the banks, and also from the point of view of relationships that they have with key sponsors in the market, especially the big oil and gas majors. So we found that there's no retreat from the market. Quite the contrary, there's more of a push forward to try and get extra business. What does that mean for the market overall? Well, we're still at a state where we have around $300 billion worth of lending into the global project finance debt market. And the market share of the banks remains around 80%, whereas the capital markets or project bonds and so on is increasing, albeit from very low levels, but still represents roughly around 20% of the total. So there is a growing market, and the banks remain very vibrant and maintain the lion's share. If we start to look at the more recent performance over the first 3 quarters of 2015, you will see here just the trends are fairly positive. There's steady growth in the EMEA and the Americas region. The overall growth over the first 3 quarters was 7.1%. In the EMEA region, it's actually above that at 7.7%. So we're seeing above average growth in this region. And I think the main thing to highlight is that we're now back at pre-crisis levels of activity in terms of project financing. You won't see this detail very well, but effectively this shows what the top 10 deals are according to latest data from Thomson Reuters. Just suffice to highlight that the energy sector still makes up the largest deals in the global league. but I think we would be remiss in not highlighting that this could change going forward. From our point of view, we're starting to see energy projects, especially oil and gas projects, start to decline as a result of low pricing in the commodities market. And also, some of you may have come across the concept of asset stranding concerns. In other words, the concerns that we are starting to hear about in terms of carbon constraints affecting the investment potential of new exploitation of reserves. If you, for example, look at what the IEA, the International Energy Agency, is saying, there's still going to be growth in oil and gas, but it's going to be an issue in terms of going forward because of the carbon budget if we're going to go towards a 2-degree target of global warming as being the limit. This is all going to be debated, of course, at length at Paris at the end of this month at the Climate Change Summit by the UN. But if we take into account that there could be a move towards a 2-degree limit in global warming by 2050, that effectively means that 2/3 of the world's global fossil fuel resources will not be able to be monetized. In such an eventuality, if policy does go in that direction, and still remains an if, then you've still got an issue regarding asset stranding in the oil and gas sector, and of course, the mining sector. Nonetheless, at the moment, energy, in terms of represented by power and oil and gas, are representing 2/3 of the total activity in the global project finance market, followed by transportation. And that really is no great change from historical levels. If we look a little bit more closely at the EMEA project finance market, there is a slight difference in trend here. The power sector still representing the largest sector in terms of activity, but this includes substantial renewable investments, renewable energy investments, especially in offshore wind, which has been one of the major areas of growth in the European project finance sector. And interestingly, bearing in mind my previous comments, the transportation sector has overtaken oil and gas as to the number 2 slot. So that reflects, as I said, the impact of declining oil pricing on projects and the curtailing of capex investments by the oil and gas majors, which has started to happen. But I also believe and would argue strongly that this also reflects environmental concerns and pressures on the sector. So expect that trend to continue. Interestingly enough, the petrochemical sector has somewhat benefited from the oil and gas demise because of the lower crude prices reflecting better margins for refineries. So we're starting to see refinery projects pick up again, which is kind of like a counterbalance to the sort of more problems that we see in the upstream sector of the market. And then at the far right end of the scale, as I hinted at earlier, the mining sector has all but collapsed over the past few months in terms of new deal flow, and I imagine that you won't see a new coal mining project for some time to come. This is just again a split of the largest deals in the EMEA region. The big ticket transactions remain in the energy sector, but transportation and renewables feature highly. Interesting to see in the transportation sector the big PPP transaction in the UK, XL Trains, as well as the big transaction in Turkey. So we're starting to see some interesting transactions come forward on transportation, and I imagine with the focus on network connections going forward from the EU, we will see more of those going forward. So let me shift a little bit in tack away from the state of the market to how funding for infrastructure has developed over the past few years, because I think this is a major point of interest if we are to understand how it's going to develop going forward. The first thing I wanted to, I suppose, talk about is really where public funding for infrastructure is at the moment, because this is a debate which is raging throughout the media and in policy-making circles. Let me read to you, first of all, a quote from the Financial Times on the 7th of October, shortly after George Osborne announced the setting up of the Infrastructure Commission. And it says, in economic terms, more infrastructure ticks every box. It enhances productivity. While building, it also creates jobs. With interest rates near to all-time lows, the financing costs are nothing to fear. Should prudence or ideology demand the use of private instead of public money, there are pension funds crying out for a stable return if the state bears the construction risk. So, the theme that we're starting to see emerge is that public funding is the issue, not private financing. Now, if we look at these tables here, this was already being highlighted by the likes of the European Commission and the European Investment Bank last year. As monetary constraints and monetary policy reform and structural reform start to bite in the Eurozone, the Commission has focused its attention on how to stimulate more growth in the economy and also create more jobs. This is the major tenet of the so-called Juncker Plan, which came out more or less at this time last year and has now been rolled out and passed through legislation in Brussels. So the Juncker Plan, essentially, I'm sure most of you know about it, is an attempt to try and stimulate the economy through extra investment in infrastructure. 315 billion euros has been slated for extra investment over the next 3 years. The idea behind the Juncker Plan essentially is to leverage, in the loose term of a word, public funding in the form of grants and guarantees provided by the EIB and member states of the Eurozone to try and attract more private finance investment. And so far it has been relatively successful in stimulating some deal flow, but it's got a long way to go. We've published our thoughts on the Juncker Plan earlier this year. So if you're interested in getting more detail as to what we think about it, you can get it in the break. But essentially, our views is that it's ambitious but achievable. Why do we think it's achievable? Because in a way, 315 billion euros is a drop in the ocean in terms of infrastructure investment. A lot more is required than that, but nonetheless, this is a good start. And the Juncker Plan, by setting up not only sort of a financing guarantee platform for extra investment, but also the architecture and infrastructure to achieve it in the form of an infrastructure portal, as well as an advisory hub, is going some way to try to tackle the blockages that we see in the infrastructure market. And I'll come back to that in a minute. But if we see what's happening in terms of PPPs or public-private partnerships, we are at a point where, despite there being strong demand, which I emphasized at the beginning, especially from the banking sector, but also, of course, from the institutional investor and insurance sector, there is a woeful amount of supply in terms of new deal flow in the European PPP market. The lack of pipeline is a perennial problem, and that also is reflected in the number of deals that are coming through in PPPs. There were approximately 76 in 2013, but still way below the 137 transactions that we saw back in pre-crisis days in 2007. So we are way away from the highs of the PPP market, and I'm sure most of you are aware or even suffering that. Why does this reflect the macro picture? Well, if we go into the macro side of things and look at investment in public and private sector in infrastructure, you will see that there has been a decline over the years in terms of overall amounts of private and public, and they tend to match each other quite closely. There is a clear correlation between the two since the financial crisis. As public financing and public funding goes down, so does private investment. There is a slight uptick in 2014, and maybe that reflects things are going to be better. Let's try and be optimistic, but it's very clear that since 2008 especially, there's been a commensurate decline in both private and public investment in the sector, and that really reflects our view that there is a stubbornly weak macroeconomic environment in Europe, and that's going to be the case for probably a little bit of time to come. So, how is that reflected in the market? Well, we did some research earlier this year, or in the summer, in collaboration with UCL. And we went and interviewed a number of market practitioners and policymakers as to what they believed were the key obstacles blocking infrastructure funding. Again, on the premise that we believe that public funding is suffering a deficit and private financing is in surplus. So what is actually blocking the two coming together and creating more deal flow? The results that we got are, you probably can't see very well, but the report's outside, is shown in this spider chart. The key obstacles were effectively austerity and affordability. In other words, governments were not prepared to put their balance sheet forward or their budget forward to fund infrastructure, mostly because they felt that they were already heavily indebted, and to take on more debt for infrastructure was not going to serve anybody's purpose, let alone the Growth and Stability Pact commitments under the European Union. So that, in effect, was the biggest constraint in terms of funding for infrastructure. So we have governments which are burdened down with debt, who do not want to fund infrastructure despite, and this is interesting, despite understanding the positive impact that infrastructure investment has on the economy. We've actually done studies on that to show that the multiplier effect of infrastructure investment across the Eurozone is roughly 1.7. So for every euro you spent, you get 1.7 euros back in terms of GDP growth, and also a commensurate job creation of about 600,000. So there is an understanding that infrastructure investment does lead to economic growth and job creation, but there is a reluctance, a strong reluctance to spend the money. Now, there are other issues that come into play, such as, and this is focused very much on the PPP market, but perception of risk, concerns about political and regulatory issues, and again, this is something which is very strongly felt in the market. Also, the distrust of the private sector. The feeling that, and this is a political issue very much, that if you allow private sector to come into funding infrastructure, that they will take over and that there will be some form of gaming or excessive rents taken by the private sector, which is, again, something which is political. And the other burden is, or obstacle really, is a lack of resource and training, and that really is something which the EU has also recognised, that there are governments out there, especially in the southern and eastern periphery of the Eurozone, who either just don't understand public-private partnerships, not alone because they don't trust them, but they just don't understand or have the resources to be able to do feasibility studies and build up business cases. So these are the obstacles that were highlighted to us, and again, if you're interested in finding out more, our research goes into this in more detail. So where does that leave us in terms of the funding gap? And I think it's important to emphasize that our view is that PPPs are only part of the solution. There is indeed other innovation that's required from the public sector to try and stimulate more deal flow and get the funding behind these projects going forward, so that the financing which is out there, there's surplus liquidity in the markets to come forward. Bearing in mind that 2/3 of all infrastructure funding is coming from the public sector in the form of grants or subsidies, unitary payments or charges. That is all publicly sector backed. So without the public sector putting their cash behind infrastructure projects, you're not going to get the deal flow coming forward. Now this is, as I said, a perennial issue. It's not new. It's something that's been recognized for some time. The great and the good have been focused on this for quite a while. I've been involved with the B20 Infrastructure and Investment Task Force. The B20 is the business side of the G20. They're going to be making their recommendations to the G20 in Turkey in a couple of weeks' time at the summit. And the focus of their recommendations very much is on how to try and unlock the deal flow by focusing on better and more effective public funding of infrastructure. Now, that's not just by encouraging more use of PPPs, although that's one of the main recommendations. There are other ways of trying to get more out from your money by either sweating the assets, refurbishment, better maintenance of existing assets, that costs less and the resulting benefits to the economy and job creation are just as high. There's also an emphasis on recycling existing infrastructure assets. By that, I mean either sales, privatizations, or transfers so that you can actually get more or better and more efficient usage of infrastructure. There's also the proposal to try and use more ring-fence taxation. And by that, if you think of Crossrail as a good example where there's a specific ring-fence taxation on business to try and fund a large infrastructure project. In fact, I think it's about 2/3 of Crossrail is funded through those means. And finally, PPPs, of course. So better, more efficient use of PPPs, not PPP for PPP's sake, but well planned out, strong economic rationale and business cases, and then using expertise to try and establish the right risk-reward transfer and balance. So that type of innovation, I think, will go to trying to reduce the gap, as you see here from this chart, estimated by McKinsey for the B20 of around $20 trillion over the next 15 years. So just to conclude, from my part anyway, we believe there is a funding gap, and McKinsey have estimated it at $20 trillion globally over the next 15 years. I think, after you take into account public funding, that gap actually reduces. We believe it's around 3.4 trillion a year, and of which there is a 500 billion gap which needs to be filled by private finance, whether that's from the banking or the insurance market. We believe the insurance market or the institutional market will be very much attracted, and this is an old theme, so it's not new. The yield spreads are more attractive in the infrastructure market. You can pick up a premium there. The actual performance of infrastructure and projects is better, and you'll hear more about that later this morning from colleagues from S&P Cap IQ in terms of the performance, in terms of default and recovery. And also, we know that the institutional market, especially insurers, are looking to match long-term liabilities and also diversify their asset base. So there is a number of attractions to the asset class, as well as the emphasis that's been placed politically by the EU and others to try and make sure that infrastructure as an asset class remains attractive, no less than the recent changes to Solvency II, which you'll hear about later on this morning. So finally, just from me, and I think I've come to the end of my comments here, we are in a situation of stalemate, as I've hinted at, between the deficit in public funding and the surplus in private financing. We need to match the two to make sure that there's better deal flow. We believe that risk analysis can help. I don't think it will totally solve, but it can help solve the gap between supply and demand. It will help shine light on the increasing regulatory and political risks which exist in the infrastructure market, which have been somewhat of a deterrent of late. It will help shed light on the big issue of construction risk, and I say big, it's perceived to be big by many in the market, although by our experience, construction risk very rarely, if ever, leads to a default on a rated project bond. Also, it will help with the issues regarding liquidity risk and benchmarking, because it'll add transparency and provision of industry data, and also help with the whole issue of lack of expertise and knowledge which exists in the public sector to analyze these transactions. So there is a greater need for transparency, there's a greater need for data and risk analysis. Hopefully we can contribute to that and hopefully solve the stalemate in the infrastructure market. Thanks very much, and look forward to your comments and questions. Thank you.
Just a quick question. On your last slide, you had a comment about new criteria with future tense. Does S&P intend to release new criteria?
No, this refers to the newish criteria, which was launched around this time last year for project finance methodology. So maybe it should say recent criteria rather than new. Thanks for highlighting that, Vincent. Yes.
Thank you. Can you just comment on the affordability as one of the barriers for infrastructure? What does it exactly mean? Is that, that taxpayers are reluctant to pay for that infrastructure when it's finished? What does this exactly mean, this affordability criteria? On slide 16, when you mentioned, I think it's the barriers to, the obstacles to infrastructure funding, you mentioned affordability.
Sorry, I didn't quite get your question.
No, it's on slide 16 of the presentation.
Yeah.
You address the obstacles for infrastructure funding, and one of them is affordability.
Right, are we talking about this?
Yeah, on that diamond.
This one?
Yeah.
Yeah, so the question is...
What do you mean by affordability? This is taxpayers that are reluctant to pay for those infrastructures once they are finished, via tolls, etc. Or?
The affordability, that's your question. Okay, sorry, it's very hard to hear you. The echo in this chamber is incredible. Yes, affordability, well, essentially the affordability, it comes in various shapes. There's the affordability for the state, in terms of it takes up a commitment over a 30-year, 35-year period to fund the unitary charge on a PPP project. That in itself is going to be something which needs to consider. Currently under Eurostat rules, there's only certain ways that you can get it off your balance sheet, depending on the amount of risk transfer. If you transfer the construction risk and you transfer the majority of the operations risk, then you can have off-balance sheet treatment under Eurostat. Otherwise, you don't. If you provide some kind of construction guarantee or take construction guarantee, and if you're responsible for the demand risk or an element of the demand risk in the length of the operations period, then that, unfortunately, for the governments, is an on-balance sheet PPP transaction. So it doesn't solve the problem in terms of releasing you from that over-indebtedness. And that's what the real affordability issue is. Although there are other forms of affordability issues in terms of in the energy sector, increasing utility bills if you're trying to get new investment funded that way, or the same in the water sector, or if we're talking about toll roads which are funded by the toll road user, again, affordability becomes an issue. So there's two sides of it. There's the government affordability in terms of taking on long-term commitments which are not treated off balance sheet, and there's also the general consumer affordability issue of paying for infrastructure. That's what it means.
You've mentioned yields, so spreads above the government pricing and project finance. What's the rating dependency there? So do you have some examples for project finance bonds at BBB-, at A-, and do you see project finance debt issued at below investment grade?
Yeah, the trend has historically been for rated project bonds to achieve BBB, ratings in general, not because they are naturally BBB in credit quality, but because they've been structured to achieve that. There is a sweet spot, so to speak, between the amount of debt and the amount of equity return in a project financing. So you will get engineering of the financing structure to the extent where the rating level is at the sweet spot or the optimal level for IRR, for the equity holders, and for the credit risk for the bond holders. And that tends to be around BBB. So there's no accident that that's where the majority of project bonds sit. A few years ago, post-financial crisis, there was this trend to go up the credit scale to try and achieve A- type ratings, because the belief was, not least from the EIB and the Commission, that investors, especially on a large scale, were only interested in single A debt because they were risk averse, and that's where they wanted to go. That, I think, is over now. I think because investors are looking for yield, they're much happier to go down the credit curve to a certain extent. I don't think there is a huge appetite for non-investment grade or high-yield project debt, although we are starting to see that. In fact, we actually did do a transaction recently which was non-investment grade in the road sector. So it's not totally off the scale, but it's still rare. So most project debt will be rated BBB, BBB minus, and there are a few in the A minus area, but they remain still in the minority.
Coming back to one of your opening statements about COP21, should the outcome of COP21 be a 2-degree maximum for global warming? How do you see the global market for power infrastructure? And especially, do you think that the decrease in oil and gas could be compensated by an increase in renewables?
Yeah, that's a very good question. This relates to the climate change discussions in Paris happening at the end of the month, beginning of next, known as COP21. And that's where world leaders will get together to try and hammer out some kind of agreement to limit global warming to 2 degrees maximum between now and 2050. Now, whether that's going to be achieved or not is a very big question. The current pledges by the governments which have submitted them amount to somewhere in the region of a 2.7 degree warming at the moment, so there's still some way to go. In fact, most scientists believe we need to go to 1.5 degrees if we're to avoid catastrophic climate change impacts on the globe. So whether we get there or not is another issue, but I think one thing we can make a sort of firm prediction is that there will be new policies, there will be new regulations that will be spurred by the Paris Agreement. I mean, there's no doubt, in my mind at least, that there will be an agreement in Paris. It will not be a legally binding treaty as such, because those just don't happen these days, but there will be a codification of sorts of what countries are pledging to do in terms of meeting a 2-degree target. That will lead to new policies, it will lead to new regulations, of which most of them will be to lead to decarbonisation of the economy, and the sectors which will feel that the most will be the power sector and the commodity sector and transportation sectors. But there will be repercussions for petrochemical and others. But it will be mainly the power sector which will feel that, because they burn most of the fossil fuels, and obviously the extractive sectors like mining will also feel it, because there will be there'll be a limited market for their product going forward. Now, how that will lead to more renewable transactions, I don't know, but I imagine that there will be a renewed emphasis on renewables. There will be renewed emphasis on also energy efficiency. There will be renewed emphasis on technology and innovation, such as storage of electricity and also distributed power. So I think there's going to be quite a lot of this coming out in the months to come post-Paris.
Hi. You're talking about funding infrastructure. How do you see the sometimes a mismatch of currency where you have a country? I mean, obviously you're talking about supply and demand in terms of funding and available projects, but if you think about EM or think about even Eastern Europe, how do you think the challenges are for an investor to be able to hedge, or if they accept being invested longer term in a different currency?
Yeah, the risk of currency mismatch is a real risk. There is the possibility to hedge that to some extent. There are financial institutions that provide currency hedges, but they may be uneconomic. But without such hedging, then the risk of a mismatch and the impact that has on cash flows needs to be taken into account, and certainly in our analysis on the credit quality. So it's a real risk, but it can be hedged. What you may find as a result of the need to hedge currency risk is a shortening of the tenor, because you may not be able to get swaps which go out the length of long-term infrastructure concessions. So that's an impediment for that type of transaction in countries which have volatile currencies. But it is a key focus that we have. We don't tend to find, in terms of the work that we do, many transactions with currency exposure. Most of them are either funded in euros or dollars or sterling in the UK.
Hi, on slide 18, you compare the yield of PFI bonds to sovereign debt.
Yeah.
And then you compare the default rate and recovery rate to corporate bonds.
Yeah.
Now, if you look at expected loss in terms of recovery rate multiplied by the default rate, then the difference between the two of them, project finance and corporate bonds, is about 0.5%. So I'm wondering whether it's attractive given what is the spread versus corporate bonds if the expected loss is only going to be 0.5% difference. If I'm getting if I'm not getting more than that in terms of my spread versus corporate bonds, then why invest in infrastructure?
Yeah, I mean, I think to answer your question, you have to go into a lot more detail in terms of relative spreads in terms of different rating levels. If on a like-for-like basis, you're going to get a higher yielding return from a project finance bond than you are from a corporate bond. And you are going to get a lower risk in terms of default, especially the transition rate from a project or infrastructure bond than a corporate bond. So that's where the trade-off exists. You're getting a better yield for less risk. Not necessarily a huge improvement, but every little helps. In terms of recovery, I think this is probably the major benefit, where you are getting substantially higher recovery rates in project debt than you do in corporate debt. And that reflects the fact that project debt is structured and has a lot of protections in terms of lockups and other covenants, which you tend to see coming from the structured finance market. Again, historically, those protections in the structured finance market have evolved for much higher rated debt, sort of to try and achieve AA or AAA type of transactions. But nonetheless, they've basically transferred across to the project market. So you're finding that you're going to get a bond, say at BBB, with, in many cases, AA or AAA protections built into them. So that, in a post-default scenario, in a recovery scenario, gives you that extra uplift, which, again, if you're looking at expected loss as your main measure of credit risk, gives you that extra uplift, which puts you at an advantage over commensurate bonds in the corporate market or even sovereigns. Okay, well, thank you very much for your questions. Thank you.